Just in the month of May, Adam, we've seen a 700% spike in gold delivery from last year, same time, and which is May's usually a quiet month for gold. We've seen the largest delivery into the history of the COMEX market. Last I looked, it was over 16,000 contracts at 100 ounces apiece. People are institutions, whoever the heck it is, U.S. government, Treasury itself, I don't know. They're standing for delivery at a level nobody has ever witnessed before. 16,000 contracts, Adam, is $5.3 billion worth of gold.
Wow.
The largest delivery in the history of the COMEX market, not just in gold, but also in silver too. So there's a huge demand for physical holding of gold and silver. And you look at, the gold price that gets knocked down by $200, $100 for 2 days in a row nearly, and it shoots right back up. That's strength and resilience that I have never seen in 35 years. To me, the physical demand is overwhelming the paper price. And this is, I was reading something on X the other day, a comment, if you will, between Vince Lanci and Luke Gromen. And, Luke said, now imagine what happens if it was the U.S. government bringing back that gold. And the response to all the commercial banks, because they were basically saying that it almost looked like a sell-only market, that they were a coordinated fashion, that they got together with the managed money and said, this is about to blow up the whole market. There is no more buying allowed, only sell only. And that's what he was intimating. And he says, in response to the above from the U.S. government is FU, he says, send us more gold next month too, and more behind for July, August, and September. And Vince Lanci says, it was, Luke, it was. No ifs, ands, or buts. It, bullion banks to cover the Treasury, calling it back, or the Department of Treasury itself, it most certainly was. Now, these are two of the smartest guys in the world. And basically what they're saying is that it's the U.S. government bringing all this gold back in. And if you look month over month over month over month, in fact, let me, if you don't mind, just share one thing with you.
Absolutely.
This is just the month over month increase since last year. If you can see that, COMEX gold delivery. This is not something that is just an outlier in 1 month. Month over month over month over month over month. And really, this goes back to November. Where we are, I would just simply say the biggest money in the world has been using any sign of weakness to stand for delivery and to accumulate more, and the price keeps going higher and higher and higher. And it's not just here. You look at what's happening even in China too, and the numbers are off the charts in China. I think they bought the amount of gold that they just bought was an 11-month high this last month. So yeah. I think the best of what we could expect to see in gold prices is still, and silver, is still way in front of us. I don't know it off the top of my head, but I would think it would be minuscule at best.
Like single digits? 10%?
Not even. I mean, maybe even the other way, probably the other way, if I had to guess. And net exporter would be my guess, because, the previous administration had no affinity to bringing gold into the COMEX, certainly. So it would have only been trader based. This is something different. And this really happened since November of 2024. So I don't know for sure, but if I were betting in Vegas, I would say it was almost inverse of what we're seeing here. Certainly not what we're seeing on this chart. So I don't know, but I would be way different than it is here.
So basically we're seeing a very market increase year over year, and that increase keeps gaining month over month so far this year.
Correct.
Folks that would say, hey, Andy, you can't really look at the May and April numbers because they're so polluted by people trying to front run tariffs and stuff like that. What would your answer be? That
this has nothing to do with tariffs. The conventional wisdom was that it was tariffs and arbitrage. Okay, there's a little bit of that. That's fine. But this is far different. That's the cover, if you ask me. And, you put it in context, for example, with President Trump's tweet on Easter Sunday, the golden rule of negotiating, he who has the gold makes the rules. Really, that's interesting. You put it in context with Treasury Secretary Bessent, who is a self-proclaimed gold bug, by the way, and whose largest holding in his last job running a hedge fund was in gold, that there would be a new monetary system implemented within this administration, a new Bretton Woods, he said. So, when you put all of these things together, you've done an interview with Judy, she talked about that, her idea of backing treasuries with gold. She told me, I don't know if she told you, but she told me flat out that Trump told her that he would issue gold-backed treasuries on July 4th next year, the 250th.
I did not hear that. That's actually really interesting. Okay.
Which is the 250th year anniversary of the country. She told me that he told her that. Now, what does that mean? Maybe he changes his mind, but she's a very bright lady and more or less says that that's what she was hedging at. And so I think that there's something far more important happening with gold. Far more happening with gold. And, you talk about like the smash in these markets. Well, the silver smash, 60 million ounces of silver on paper were dumped in 1 hour last week when the price got smashed. It's a sign of desperation, maybe to cover physically. I don't know, because here we are, the silver price is right back up. And I just think that this is something far different than the media is portraying. Certainly, it's a lot more than tariffs. That I would bet. I would bet just about anything against.
When I look at what happened in May, it wasn't just notable; it was historic. Usually, May is one of the slowest months of the year on the COMEX. Quiet, low volume, minimal delivery activity, but not this time. We've just witnessed the largest gold delivery in the history of the COMEX. We're talking over 16,000 contracts, each representing 100 ounces. That's about $5.3 billion worth of gold, delivered in a single month. Whoever's doing this, institutions, governments, hedge funds, it isn't retail speculators or weekly trend chasers. This isn't about tariffs either. Tariffs are the excuse, the cover story. The fundamental truth is that someone, or several big players, are standing for delivery at record levels and doing it month over month consistently since November 2024. I want my viewers to imagine not just unpacking that fact, but feeling the implications. 16,000 contracts delivered in May? That's not a fluke. It's not normal. It's not front-running headlines. It's a strategic accumulation of physical gold at scale. Buyers reaching through the noise to bring real silver and gold into their vaults. And let's not forget silver. The same record demand is mirrored there. You smash its price $60 last week in just an hour, and overnight, bam, it pops right back. That resilience, I've never seen it in 35 years. To me, that says the physical market is winning over paper price manipulation. I came across an interesting thread on X recently. Vince Lanci and Luke Gromen, two voices that know these markets cold, were tossing around theories that the U.S. government itself is calling in COMEX contracts. They were basically telling the bullion banks, that's it, sell only. No more paper positions. And they allege the Treasury snapped back with a big FU. Bring us more gold. July, August, September. When experts of that caliber draw these lines, I listen. The story only gets more intriguing when you layer in the narrative coming from the White House. Tweets on Easter Sunday about, he who has the gold makes the rules. Treasury Secretary Bent, who's been an avowed gold advocate, and talk of a new Bretton Woods-style system. Judy Shelton, who even claims President Trump told her in private that gold-backed treasuries are coming for July 4th, 2026, the nation's 250th birthday. These aren't conspiracy stories. They're triangulated clues from multiple credible insiders. You don't have to accept all of them wholesale, but what they collectively suggest is something far bigger is in motion. When you see 60 million ounces of silver paper dumped in a single hour to crash the price, and then watch it rebound just as fast, that's desperation. That's not regular speculator cost-cutting. That's the paper side losing control of reality. Because when the paper price nosedives but the physical price reverts within hours, that gap exposes who's in charge. The metal, the vaults, the buyers with actual ounces, not the synthetic inside a computer system. So let's talk bigger picture. These moves, these deliveries, these tweets, these public and private signals, they tell us something very important. Gold is no longer just a barometer. It's a strategic tool, a monetary weapon. For those holding it, political messaging is subtler. For those watching, we get signals. But if the mainstream financial pages say, it's just tariffs, I'd bet on something more structural. We're also seeing these moves play out internationally. China just posted an 11-month high in gold buying last month, yet their transactions aren't even fully reflected in global data. We all know some is under the radar. Meanwhile, India remains one of the largest importers in the world, and their buying continues. Those markets are unapologetically conscious of gold as a reserve asset, not a speculative play. Now, a lot of people say, Andy, maybe this is just traders front-running tariff announcements. That would make it noise. But if that were the case, we wouldn't be seeing sustained increases month over month. The charts don't lie. Gold deliveries have accelerated every single month since November. That's no random spur. That's a systematic strategy. One sideline no one's focused on is this. The COMEX used to be the place where paper sets the price. But if delivery spikes like this keep happening, paper starts to look more like a liability than a right. When the system gets overloaded with delivery demands, when holders are forced to take physical, there's less and less room for paper manipulation. And the COMEX loses credibility, not because of conspiracy, but by running into its structural limits. That's what you saw in late May. An orchestration only possible if someone truly intends to take delivery no matter what, from cross-the-board tariff fear to spikes to drops. They're not chasing a short-term pop. They're ensuring their vaults are filled. They're playing a different game.
I think that's the most important thing to take away. So they've been doing it, with whatever means they have, a lot of it in the black market because of import duties and whatnot. But the more wealthy they become, 100%, they'll just continue to accumulate. To them, that is wealth. To a large portion of the world, gold and silver represent wealth. And I think people need to not look at it as an investment. You don't buy gold to become or silver to become wealthy. Now, silver offers that potential. I do believe that. I have a take on silver that, and say what you want about it, but I believe the military industrial complex has been shorting silver for years. They need it in high-tech weaponry. They used to be quoted in the supply-demand numbers, and the military is gone. And I gave a speech at Vancouver Resource Investment Conference where I said there's 500 ounces of silver in a cruise missile. A guy comes up to me 3 years ago and he says, I work for the Department of Defense. I almost fell over. And he says, I helped design the Tomahawk, and I know there's silver in it. I'll get back to you. Never hear from him again. I see him the next year, 2 years ago. He says, I'll be damned. There's between 13 and 15 kilos in a typical cruise missile, Tomahawk or Patriot. He says, you were right. And then I've gotten to know him, and it's in all sorts of high-tech aerospace and weaponry. And so who owns all the military contractors? Well, that's largely BlackRock. Who's the custodian of SLV? Well, that's BlackRock and JP Morgan and also GLD. And so what happens is they step on the price of silver. Don't believe me? There's 8 commercial banks that hold the largest concentrated short position of any commodity ever traded in the history of the COMEX market. Guess what it's in? Yeah, it's in silver. And then you see the trading 3.5 times annual global mine supply, 10 times the float in London on silver by commercial banks. They hold the paper price down. They build high-tech weapons. They take it out of the supply-demand numbers. Even though we're running structural deficits, they pull it out. But they need it to make the weapons to fund wars all around the world. Then places like the Ukraine get blown up. And who gets the reconstruction contracts? Oh, that's right. It's BlackRock. So when conspiracy and reality, sure, fine line, but why would 8 banks from the West have the largest concentrated short position in this stupid, archaic relic that no one needs, that being silver? Why would the silver price, when it's coming out of the ground at a 7-to-1 ratio, ask Keith Neumeyer, he'll tell you that, 7-to-1, meaning 7 ounces of gold for every 1 ounce of silver. It's now priced at roughly 100-to-1, coming out of the ground at 7-to-1. Why would these 8 Western banks hold these large concentrated short positions, which is as dumb as a mud wall in this environment? Why would they do that? Well, because the military industrial complex needs it to make cheap weapons. And that's my belief, and I will take that to the grave with me. And the only way that gets beaten is by the rest of the world saying, aha, like China, we see what you're doing. You're suppressing the price to accumulate it for whatever the reason. But guess what? We're just as rich as you are. And we're going to do the same thing. In fact, we're going to pile on the short side with you, and we're going to stand for delivery. And at some point, the rubber will meet the road. And That is kind of, you could argue, a little microcosm of what you saw yesterday in the platinum market, where bang, up 7%. It's a short squeeze. So it doesn't mean it will continue, but that is a microcosm of what you will expect whenever you manipulate markets in this degree. They always end badly. Manipulations always end badly. You can only manipulate a market for an extended period of time by pushing it in the direction it's going. And forever, no one wanted these commodities and certainly wouldn't stand for delivery. They wanted our stocks, our bonds, our real estate, because we had trust. We don't have trust anymore. Now
Let's pivot to silver, because if gold is the general, silver is the warhorse. It's where the volatility lives, but also where the asymmetrical upside is hiding in plain sight. If you thought the gold delivery numbers were staggering, silver is off the charts. In May, a record 13,581 silver contracts were delivered. Again, an all-time high. And just like with gold, these aren't retail trades or spread arbitrage games. These are non-bank entities standing for delivery. The key phrase here is non-bank. That's crucial, because for years, the bullion banks were both the custodians and the price managers. They shorted paper, they controlled leverage, and they never feared the longs because they rarely stood for delivery. But now, over 110 million ounces of silver have been offloaded from banks to non-bank participants over the last year or two. That is a tectonic shift. We don't even know who these non-bank players are. Some speculate it's military-industrial procurement. Some whisper it's domestic government channels hedging ahead of systemic shifts. Whatever the case, when JP Morgan delivers physical to a party that isn't a fellow financial institution, you know the music's about to change. Let me say it like this. You don't deliver your chess pieces to the other side unless you're losing the board. That's what the bullion banks are doing right now, quietly exiting their short exposure. And that, to me, is one of the loudest signals out there. The system of price management through rehypothecation, fractional paper claims, and derivative leverage is being reverse engineered, and silver is at the heart of it. We've talked before about China buying silver doré and concentrate straight from South American mines, paying above market rates, shipping it home for private refining. That's not a trade. That's a national strategy. Why does the world's second largest silver producer need to import half-processed sludge at premium? Because it bypasses the Western price discovery system. It disintermediates price from transparency. It pulls physical out of circulation. In short, it's accumulation by subtraction. Remove silver from global visibility, and you not only tighten supply, but obscure volume. India is doing the same. Over 900 million ounces of silver purchased in the last 5 years, and that's just what we can confirm. The real number? Probably higher. What are they doing? Building strategic reserves, pure and simple. Then you look at the LBMA. David Jensen's work is excellent here. At peak, they claim to have 800 million ounces in the London vaults. About 500 million of that is encumbered, tied up in ETFs like SLV or with entities like Bullion Vault. That leaves about 300 million ounces freely tradable. But they reportedly trade that entire float every single day, and not just once, up to 10 times a day per their own surveys. That means they're moving up to 3 billion ounces of silver daily on paper against 300 million that actually exists. Let me say that again. 3 billion ounces traded daily against a float of 300 million. That's 10 times leverage, 35 times annual mine supply, and the whole system is naked. That's not a market. That's a fuse. If you're in London and short that much silver on paper, and suddenly you're getting called for delivery on the COMEX, what do? You stall. You extend settlement windows. And what happened recently? The Bank of England suddenly decided they needed 8 weeks to deliver gold instead of 1. Why? Not enough trucks? Not enough hands? Please, something's cracking under the surface. Some speculate this is part of Trump's strategy. Drain the exchanges, expose the LBMA, force a reckoning with Europe's financial aristocracy. I'm not saying I endorse that theory in full, but I am saying that when the world's most systemically important exchanges are being quietly drained of physical metal, someone is playing high-level monetary chess. This isn't about whether silver is going to $40 next month or $60 by the end of the year. This is about whether there's a functioning delivery system left when it gets there. What does that mean for you, the investor? It means silver represents one of the most lopsided risk-reward profiles in the financial world today. The downside is noise. $5 here, $3 there. But the upside is nuclear. Triple-digit silver isn't a fantasy. It's an inevitability if these mechanics break open. Now you need strong fingertips to hold it. You need to ignore the smash and grab volatility because silver is like a coiled spring. It's reactive, noisy, and easy to shake loose weak hands. But when it goes, it's violent. The technicals are screaming. We're sitting on a massive cup and handle breakout, locked inside a long-term bullish wedge. If that breaks, and it's testing that zone right now, it's not walking to $40, it's sprinting past $50. And here's something else that's important. The price itself is the greatest tool of misdirection. It makes people say, well, it hasn't moved. Maybe it's not worth holding. But the people accumulating silver right now, the people standing for delivery, they're not confused. They're using that manipulated price as an opportunity to drain the vaults. And they don't need CNBC to validate their move. They're acting, not reacting. I said it in part 1, and I'll say it again. You cannot suppress any commodity indefinitely unless you push it in the direction it's already heading. When the tide turns, the system can't hold it back. That's where we are. The suppression regime is buckling, and the smart money knows it. And let's circle back to gold for a second. COMEX delivery isn't slowing down. It's accelerating. April and May were records, and while gold was down over $200 in 2 days earlier this quarter, it snapped back with unshakable force. That kind of action tells you the physical market is asserting dominance over paper. Look at what the PBOC is doing. They are buyers every single day at the AM and PM fix, and they're disciplined. They wait for volatility, then load up. They know that paper specs will panic during events like FOMC meetings, tariff headlines, or options expiries, and they exploit that noise to buy massive size. Their buys don't even show up in customs data sometimes because of the layered shell game that exists in international gold movement. 40 different customs brokers in London, military allocations that go unreported, shadow buying strategies. It's not a theory, it's strategic non-transparency. And every time that happens, they're exchanging US dollars for gold. That's de-dollarization by stealth. When the central banks of the East are hoarding 400-ounce bars while dumping treasuries, you better believe something structural is happening. Just think about this. For the first time since gold was weaponized in the 1970s, we are now witnessing the West become a price taker, not a price setter. China has become the physical dog wagging the COMEX tail. When that tail gets too frisky, China just arbitrages the price and converts cheap paper into real gold. So when you hear someone say, gold's down 3%, I'm out, or silver's stuck again, remind them, it's not about the price today, it's about the functionality of the system tomorrow, because that's what the insiders are betting on. And if you're on the other side of that bet, I hope you at least own a few ounces, or better yet, several hundred. We're nearing the end of this chapter. The next one? It's about monetary reconfiguration, sovereign recalibration, and a return to truth-based money. Fiat systems break quietly, then all at once. The people accumulating metal today won't be chasing headlines tomorrow. They'll be the ones writing them. If you're watching this and still on the fence, let me say this clearly. It's not too late, but it is getting late. Whether you're buying gold to hedge, silver to speculate, or both to escape the paper lie we're living in, just make sure you own the real thing. Because when the illusion shatters, only the weight will matter. Get your weight right. We're not in a normal cycle. We're in a monetary regime shift, and this is your front row seat.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.